Rohr here with an early concise highlight on Wednesday, October 22nd, 2014. It is currently 7 a.m. U.S. Central Time, and it is going to be very concise today because the only thing we're going to be actually looking at is the S&P 500 due to everything else being still very consistent with our discussion from yesterday morning's global view. And there has been quite a bit of macro influence overnight. So, what does all this mean to the markets? And what we can see is that in spite of the stronger data Tuesday, the market had already shaken off Monday's early weakness, as you can see from that IBM miss, and is just once again a bit of a bad news is good news market. And even then yesterday, good news is good news. And the S&P 500 is just off a couple of bucks this morning. It's trading about steady, as are, relatively speaking, so many other markets. And what we had, though, is the S&P 500 overrunning yesterday late. The Fibonacci two-thirds retracement here at 1934 of the whole swing from the all-time high up at 2012.50, or the 2013 area as we put it, which was the high for both the September contract before expiration, then December contract, down to last week's 1814 trading low. And that's important because it speaks of the ability of the market to range up further. And we've actually put in the Fibonacci retracements after this sharp swing up from the low to yesterday's high, and we'll be continuing to update this on a day-to-day basis to see the sort of levels the market might hold at on the way back down. And most especially, we're interested if the Fibonacci's, just like the overrun Fibonacci level on the resistance back in the 1885 area, more or less, if that's continued to be reinforced by Fibonacci retracements of the current upward swing back into 1885 or somewhat above it. Most importantly right now is the 1908. If there is a drop straight down from here, even an orderly quiet one, the 1908 Fibonacci 25% retracement of the current swing, because of course that's right around the low of the gap, the high of the gap, yesterday's early trading low from around the opening at 1909, from which the market strengthened. And of course the gap back down to the key 1900 area is very important, and this is now a primary short-term support area, right in this 1909 to even area that correlates very well with the bigger intermediate term levels we've been looking at for a while. As a matter of fact, I have to kind of shorten up this scale on this hourly MACD to show you that much like the market escaping to the downside, going back to the Thursday the 9th failure that fed on itself for a week, we're now well out to the upside. So even if there is some kind of correction, we presume the initial pullbacks will hold into support, even if this might be part of a broader ranging top back up into 1950 or even likely 1975 to 78 area. We shall see. That about does it for the in-depth sort of short-term view of the S&P 500.